Yeah, I'll just say philosophically, like, the question is, what is secondary, right? So there's secondary locations. We've talked about which might be regional cities or out-of-favor submarkets with bad transit or, shifts in, call it, local demographics. Those we would try to avoid. Secondary assets that have bad construction and design characteristics, as I talked about, ceiling heights, column spacing, the basic structural grid of the building, we would try to avoid. And I think historically people have thought that short WALT meant secondary, right? Short weighted average lease term meant that there was something fundamentally wrong with the building. What's happened in CEE is, leases expiring in 2013, 2014 were signed in 2008, 2009 on 5-year cycles. So the WALT is only issue because there needs to be a mark-to-market on those rents, right? They were pre-crisis rents that are probably going to roll down 20% in the next year. So I think the market has viewed that as secondary. We don't. Like Pradera, we view that as value-add opportunities. You just need to be able to underwrite those rents properly, have some confidence that your asset management teams can extend the lease length and stabilize the income profile. And so that's the secondary we're looking at. Good bones and good locations that just need active asset management. And then we don't call that secondary, right? We just call that core with a scratch, or we call that, a value-add opportunity, really. And so the problem, I'll just say this, and I don't want to go on too long, is that CEE hasn't had historically local investors who have bought less than the best buildings. Now, the U.S., all the cities are driven by local investors who have no problem with Class B. UK has a ton of Class B product in it. I don't know France very well. I know that, Netherlands is in great distress right now. I know there's a lot of Dutch investors. But I think we saw in Prague, we've traded 2 assets in the last year from our third fund, which the market would have called secondary, that both traded. One was a retail park at a sort of 8% yield. The other was a logistics building in Brno that I'm sure Ben knows, that traded, close to 7. And the market saw those as totally secondary, and they went to local buyers. And so I think that's what's going to fill the gap that maybe Mike talked about, and you're seeing local buyers in Poland now.
Yeah,
so.
look, I mean, we think it'll start to come through. There's a few, local pension funds, and one of your questions may be about the growth of, Polish pension funds, insurance companies. It will come, but there's not much there now, but we hope it will grow. Because Czech has quite a few local high net worth individuals. For Poland, it's not yet there, but hopefully it will.